Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. It's just now to go into the closing bell, and stocks are lower. Taking a look at the popular averages here, the Dow's down about 360 points. The S&P 500, your broad gauge, is down about 0.4%. The NASDAQ now is basically flat. Let's welcome in here Jared Blickbury joining us to break down the headlines. Jared, what are you seeing in the markets?
Well, thank you. We're kind of seeing the flip from yesterday. Yesterday, tech was doing poorly, NASDAQ was down, and the Dow was leading, and today it's kind of the reverse. So let's take a look at the Dow, which is underwater by about 330 points, or 0.7%. We're not far off of the lows right now, but not a huge down day in the Dow. And then in the NASDAQ, you can see we've been both positive and negative, more red here for most of the day, but now trying to climb into positive territory. And the S&P 500 down about 1/3%, and kind of looking like the Dow chart just a little bit. Also want to show you what's happening with the small caps. Russell 2000, that's down 0.6%. And we're going to flip over to the bond market. Then we're going to look at some sector action. But let's take a look at what let's take a look at the 10-year. We can see that's down 3 basis points to 4.15%. It's kind of been on the rise recently. Now it looks like it's declining, but it's really in kind of the middle of the year's trading range and not much of a consideration for equities right now. 30-year bond down 3 basis points to 4.82%. And the U.S. dollar index just slightly negative, down 0.2%. The early indications, or the early trading in the futures after that jobs report we got this morning, was to the upside, but we didn't get very far. And as you can see, things have been mostly in the red today. But here's the sector action. Communication services, tech, and consumer discretionary, the three mega cap sectors, just barely positive. But what's not positive is energy. That is trading to the downside, about 3% off there. And then half of that loss, so we're seeing healthcare, XLV down about 1.5%. And the rest of the sectors, you can see kind of a mix of down 1/3 to about 1%. And if we take a look inside the NASDAQ 100, Tesla is a standout. That's up 2.2%. 480 is my big price level, and you can see it's at 486 right now. So closes above there are going to set up a nice potential bullish run. Meta up 1.5%, and not a lot of outside movers to the upside or the downside. You know, I do like to dig into the semiconductors, and we're seeing a lot of red here outside of some of these bigger names like Broadcom and Nvidia. A lot of red. Looks like ARM is 3% down. And then closing here, we got software. It's a different look. We got a lot more green to celebrate. Oracle up 2%, so is Intuit, ServiceNow, Shopify, just a little bit under that. But Snowflake also up about 2.2%. Josh.
All right, Jared, thank you. Well, a fresh batch of economic data is sending mixed signs to investors. Retail sales signaling strength, countering the sluggish jobs report. And here to make sense of it all, we have Interactive Brokers senior economist, that would be José Torres. José, always great to see you. So we did get that big batch of data this morning, José. You were looking through it. What did you make of it, José? What does it tell us about the labor market, where we are and where we're headed?
Great to see you, Josh. Slow down angst. Let's start off with some 50s. 50-month high in unemployment, 59-month low in October job losses. That was the worst going back to December of 2020. And then wage gains slowed down to a 54-month low on a year-over-year perspective. Now, what really countered a lot of that slowdown angst were strong prints in the other areas, like core retail sales, the control group. That reflected household spending strength. And then the flash PMIs they weren't excellent for the month of December, but they were solid. And Josh, finally, the new weekly indicator from ADP showed a nice rebound in hiring from around 4,000 last Tuesday to around 16,000 on an average for the last 4 weeks this morning. So normally you would have expected such a weak jobs report, particularly for October, and then in November, the soft sector breadth, you would have expected yields to be down maybe 10 or 15 bips and Fed easing expectations to rise dramatically. But that's not what we're seeing, Josh, because the other reports really countered the weak BLS report.
You know, José, one question I have for you as an economist is, Trump imposes these tariffs for a couple big, broad reasons, right? He wants to rebalance trade relationships. He also wants to bring home manufacturing. And I'm curious, as an economist, you read through these reports, José, do you see evidence that's working? Do you see evidence of broad reshoring?
The orders aren't there right now, Josh. Demand has been particularly weak. Part of it is elevated prices and high interest rates. And because the demand hasn't been there, the hiring has been soft. When we look at manufacturing from January 1st to now, we're down quite a bit. Now, investment, Josh, that's where the strength has been. But it's not clear that these significant investments are really going to drive employment much higher. Because remember, manufacturing is becoming less labor intensive. It's more about artificial intelligence. It's more about automation. So who really is going to benefit here? Is it going to be the shareholders in the S&P 500 and the Magnificent Seven? Or is it going to be the folks that are expecting or awaiting a manufacturing renaissance and the return of high income jobs to a lot of areas in the US?
Jose, so we got your take on this jobs data. I'm curious what you think the Fed made of this data. Do you think it impacted their thinking, Jose, which seems to be take a pause, see how the economy evolves?
Absolutely. Labor market fragility has been the justification for dishing out 3 consecutive rate cuts at 3 consecutive meetings. Now, as far as what we're expecting going into next year, our markets here are expecting roughly 2 cuts. That, of course, could be more significant. Now, what's helping here is that the weakness in the job market isn't severe. It's a slight slip. Some months we get some strong numbers like we got in November. Other months like in October, you have some losses. Part of October, by the way, was a lot of federal employees accepting those buyout offers from the Trump administration. So, we're getting mixed signals in the labor market front, but things aren't totally derailed. And that's been a positive. As far as the Fed, I think that they feel pretty good that they've decided to cut rates because Wall Street is wondering today, is the Fed too late in saving this labor market? Should they have begun to cut a lot earlier, perhaps in the summer?
What do you think, Jose? Too late?
I think they're right. I think they're right on. This is a perfect balance. I think you want to do one more before Chair Powell's term ends in May. I think you're at a nice level here because you're balancing the labor market risks and the inflation risks. We get CPI on Thursday, Josh, expected to be around 3%. So the Fed is essentially allowing the economy to overheat here with inflation at 3%. And that's great news for corporate earnings and for stocks. And that's why we're getting this buy the dip in the last hour of trading in case we get a recovery rally tomorrow.
Let me ask you, you mentioned how Powell's term is coming to an end there. I'm just curious, do you think there is a candidate for next Fed chair that the markets prefer, Jose? Hassett, Warsh, Waller, what do you think?
I think the markets prefer Warsh. I think, our prediction market has Warsh on top now, 45%, Hassett at 41%, Waller at 9%. Hassett has been too vocal, Josh, in terms of favoring an apolitical central bank that isn't influenced heavily by the White House. Of course, Josh, that's not what President Trump wants to hear. I think that former Fed Governor Kevin Warsh is going to be able to thread the needle a little better there in terms of preserving central bank independence while also appeasing the commander-in-chief.
I want to get your take, Jose, on another issue front and center for a lot of Americans, which is affordability. This kind of broad economic anxiety, Jose, which has become a political flashpoint. It's interesting how you define the term affordability. How do you, as an economist, think about that, Jose?
Well, one thing that's top of mind is the spread on inflation versus wage gains, and that spread is compressing significantly. We saw this morning average hourly earnings 3.5% year over year, CPI roughly 3%. So real wage gains have been carrying the consumer for quite some time here, but that progress is now being curbed by labor market deceleration. As far as how I look at affordability, one of the most important factors, of course, is to what extent are shoppers engaging in discretionary activities, discretionary services? What's the broad aspect of it? Is it being carried by all cohorts? Right now, we're getting increasing evidence that the high-income cohorts are comprising the majority of U.S. spending, where the middle-income and the lower-income cohorts are having to prioritize staples and can't really engage much in discretionary activities. The risk there is that if you have some kind of stock market turbulence or correction, that the high income shoppers are going to drop their spending, and then we could be into a more pronounced slowdown perspective. But overall, I think that's what it's all about: staples versus discretionary.
Jose, always great to see you. Always great to have you on the show. Thank you.
Thank you, Josh. Great to see you.
Coming up, we've got to look at some of the top trending tickers on Yahoo Finance, including Pfizer, which is selling off in today's trade. Markets heading into the new year on the back of strong gains in 2025, but many are wondering how much longer this can really last, especially at this rate. My next guest is looking back at history to get a sense of what we can expect. Join me now, we have Lindsay Bell, 248 Ventures Chief Investment Strategist. Lindsay, always great to see you. Let's start here. As we head into 2026, Lindsay, you draw a comparison here to the mid-90s. How come, Lindsay? Compare and contrast these periods.
Well, there's a lot of similarities that feel like the mid-90s, okay? So you've got a consumer who is pretty downbeat, right? We're going to get sentiment on Friday. We'll get a touch there. The consumer wasn't feeling great in the 90s, even though the job market was considered pretty good. Still, unemployment was in the 4.5% to 5.5% range over that decade. CPI was sticky at 3%, which is what we're expecting from CPI later this week. And all the while, GDP growth was strong and the market continued to rocket higher. In the last 5 years of that decade, the average performance in the S&P 500 was up 26%. So those are where I see very, very much similarities. AI is a transformative technology that we're going through now versus the computer and internet age back then. It displaced a lot of workers. 2.2 million people lost their jobs between 1995 and 1996. Old jobs went away, new jobs were rebuilt. A lot of people were taking on second jobs, moonlighting. We saw that sort of today in the jobs data where part-time work was up. And so that's where I see the similarities.
Well, you mentioned AI. We're all trying to think through what AI's impact, Lindsay, could be on the labor market, on GDP. How do you think through that?
Yeah, I think that 2026 is going to be the year where we start to see AI really expand across the economy. It's going to benefit markets. It's not just going to be a one-horse pony. We're not just going to see the hyperscalers and the Magnificent Seven leading the market. It's expanding into other sectors. If you look at industrials, you look at financials, you look at some of these other sectors that are starting to benefit from the AI infrastructure build. You even look at the old tech stocks. If you look at an IBM, for an example, or even Oracle, I know they're taking on debt to do that, but you're starting to see an expansion. So it's coming through also in margins. It's not just margin expansion within the information technology sector. You're going to see it in the industrials, the materials, and even the consumer complex is expected to see margin expansion, which will drive earnings growth. So the S&P 500, it can be driven by more than just tech. It's going to be these other sectors participating, which is a good thing and a good sign of a healthy market.
You mentioned Oracle taking on debt like that. When you see that, Lindsay, more companies tapping the debt markets to finance their AI dreams, is that a source of concern for you?
I think we have to take it on one by one basis, right? If you look at the Mag 7 minus Meta, who's also taking on a lot of debt, free cash flow after CapEx is still expected to grow 18% year over year. Yes, that's slower than in the past, but that's still positive free cash flow growth. You look at revenue versus CapEx, revenue growth, cloud revenue growth for the Mag 7 minus Meta, again, up 23% expected in 2026 versus CapEx spend up 29%. So that's not that misaligned. But I do think that we need to keep an eye on each individual name and really focus on the cash flow and the fundamentals of the businesses.
Looking into 2026, total return then, according to Lindsay Bell for the SPX, the S&P 500, 8%, Lindsay, 10%? What do you think?
I think a low double-digit return next year is good.
Low double-digit.
Low double-digit. It'll be the fourth year in a row. It looks like this is going to be the third year that we're getting double-digit price performance in the S&P 500. So next year will be the fourth year. And I think it's really going to be driven by earnings growth at 14% and margin expansion at over a whole percentage point. And so I think that's critical. My one risk area, I don't think it's all hunky-dory. We're going into the new year with some concerns, one of which is valuations, which I do think that the margin expansion from other sectors helps to offset the PE concern. We're at elevated PEs because we're going to have new all-time highs on our operating margins within the S&P 500. But I do think that the consumer side of things, that's where I worry. Your previous guest talked about kind of some of the concerns within the consumer space.
That K-shaped economy is what he was highlighting. Yeah.
Exactly. Yeah. And so I think that there's enough stimulus to help the lower to middle income, especially in the first half of the year, lower oil prices, as well as the tax refunds from the one big beautiful bill. But I think once we get in the second half of the year, we really do need to see the job market improve and wages for the middle income to lower income start to improve as well, because budgets are tight now. There does remain inflation in key big ticket items like healthcare or insurance. I just got my homeowner's insurance increase this year. It was astronomical. And so I think that, and the tariffs will hopefully, we'll start to see that taper off. But we do know that a lot of companies have been able to take on those extra cost increases related to tariffs. And I think part of the reason they've been able to do it is because they've been so critical about cost cutting, and some of that cost cutting has come from layoffs that we've been learning about over the last several months.
There was a stat, Lindsay, I don't know if you saw this, Bank of America survey of money managers out. I don't know if you saw this one. Most bullish of the past 3.5 years, Lindsay, as a sign of that, cash levels crashing to a record low. One, what do you make of that? And two, when you see that, do you think, well, maybe that's a worry? Like, is everybody on the same side of the boat?
Yeah, no, I think, look, these things ebb and flow, right? And so I think it's something to keep an eye on. It's something to, maybe it's time. The market has run quite a bit. We are at elevated valuations, even if I think that they're to some degree justified at this point in time. Digestion is good. I think what we're seeing now is good. We're so far at a year where we're going to see about 17% increase in the S&P 500. That's an amazing story, especially when you think about where we were at the beginning of this year with the tariff debacle and how low we went, and we've rebounded miraculously, and so, or spectacularly is what I should say. And so I think it's something to watch, but again, you got to follow the macro trends, which you've got softer monetary policy, which supports equity upsides. You have a lot of spending on AI investments, and it's not just going to be the hyperscalers this year. It's expanding into other sectors that's going to support GDP growth, and there is other stimulus coming into the system. So I think it's really going to be hard to fight the tape, and the fundamentals should be supported by those macro trends.
I'll get you out into this. Bottom line, given the backdrop, the environment we find ourselves in, what sectors do I want to overweight in 2026?
So going along with those themes, I'm going overweight industrials and financials. Again, it's an expansion of that AI theme. They're both winning from it. Industrials just getting more business in the build out of the AI infrastructure. Financials, you're starting to see it in terms of efficiency and productivity, which also should expand into other parts of the market. But I also think that a recovery in the manufacturing, the contraction, reversal of the contraction that we've been seeing, the elimination of tariffs, or us getting past the tariffs, I guess I should say, is also going to benefit industrials. And then for financials, capital market activity, again, given those macro trends, should continue. So M&A market, IPO market should be good. And then additionally, a lot of that sector, talking about a K-shaped recovery, they really cater to the affluent market or institutional market. And so I think those are two areas of strength, and so that should benefit that sector. And then also I think you've got to still be involved in tech and communication services, because they are the center of this AI revolution, and they are going to continue to drive significant growth in the year ahead.
Lindsay, always great to see you, especially on set. Thank you.
Thank you.
Now time for today's trending tickers, and Yahoo Finance's Brooke DePalma join me here. We're going to take a look at Pfizer, Humana, and Kraft Heinz. We're going to start with Pfizer. Those shares are under pressure after the company's 2026 outlook disappointed Wall Street, Brooke. So they said they forecast revenue here, it looks like between 59.5 and 62.5 billion for 2026. The midpoint of that range does trail consensus.
And really what we're seeing here is how exactly Pfizer moves on after those run up of COVID-19 sales. The company, largely saying that COVID-19 product sales is expected to decline $1.5 billion from 2025. They also expect another $1.5 billion in revenue from product exclusivity loss next year. And so lots of downward momentum here. But perhaps one catalyst here could be what exactly they do in the obesity space. And Bank of America saying in their note is that Pfizer's ability to re-rate to a growth multiple will likely hinge on competitive positioning within obesity. But then they are saying that this will take several years to play out. Keep in mind, the stock is down about 5% on the year so far, and definitely, not looking good as we make our way into year end. There are about 15 holds on the stock, but there's still 14 buys.
Turning to Humana, that's another name on our radar. That company announcing a leadership transition in its insurance segment. The managed care firm, Brooke, they reaffirmed their adjusted EPS forecast for the full year. It looks like they still see adjusted EPS of about 17. Bloomberg pointing out here that forecast does fall shy of analyst estimates.
And another interesting point that they also mentioned today was that they are announcing a new executive. The new president of their insurance segment or rather the former president plans to step down. They named a new president, and it's actually the Amazon healthcare executive, Aaron Martin, as his successor. And so perhaps there's some excitement there. Evercore ISI saying in a note that they see the appointment of Aaron as an interesting choice and one that may help Humana as an integrated technology transition. So perhaps we are seeing a bit of downward momentum, down about 6.5%, largely based on that. But on the backside, that insurance president seems promising about how Humana will move into the future.
Yeah, stock is basically flat this year. Most on the street,
2%.
Still on the sidelines. Finally, Kraft Heinz names its new CEO, who most recently served as chairman, president, and CEO of Kellanova. So they did name Steve Cahillane as their new CEO. Will lead the company, Brooke, after Kraft Heinz splits in two. That's expected to be completed in the second half of next year.
Yeah, and definitely some optimism here. I mean, the stock, Kraft Heinz, seeing about 0.5%, a bit of a pop, making our way towards the close. But if we know anything, is that we know that value creation, what ended up coming out of that split, Kellogg's kind of setting the precedent back in 2023, doing this split between the two companies. And then what ended up happening there is that Mars acquired Kellanova, the company that he oversaw, for $35.9 billion. And that deal just closed. And so with this split of Kraft Heinz, definitely investors hoping for similar value creation here. And it's worth noting, too, that this segment that Steve will oversee is some of the brands that we know the most. It's the crown jewels of the portfolio. It's the Heinz, it's the Philadelphia, it's the Kraft mac and cheese. And so it'll be really interesting to see how he gets his hands on this business. Of course, he's a veteran in the industry. He's held roles in many other companies. And so definitely interesting to see how exactly he will lead this brand as well.
Yeah, has not been a great 2025 for the stock, down about 20% year to date.
Definitely.
Thank you, Brooke. Coming up, one of the biggest market moves today, oil prices, crude tumbling below $55. We've got the latest coming up. Oil prices are breaking down in a big way today, falling to their lowest levels in 4 years. For more, we're bringing in Yahoo Finance's Jake Connolly. Jake, explain this. What is going on here?
Yeah, great to be here, Josh. It's a few things. I kind of think about this story in two parts. The first is this massive wave of oversupply we're seeing build up. OPEC has unwound nearly 2.9 million barrels per day of cuts, adding that back to the market since April. They're pausing in Q1, but who knows what happens after that. The U.S. has kept pumping. America's countries like Brazil and Guyana have kept pumping oil. At this point, the IEA, International Energy Agency, sees that getting up to 3 or 4 million barrels per day, which is a huge overhang for the market, and that's going to keep pushing prices down. You've also got weak factory data out of China. Maybe some of the demand slows down there where they've been a big buyer supporting that market. Also, you've just got Ukraine and the Russian war, all the sanctions, right? If peace talks move forward, that's going to be bearish for energy prices because that means if those sanctions get lifted, if a peace talk happens, maybe those barrels from Russia that are blocked right now and under sanction are going to get added back to the market. You've just got even more coming, right? And then the second thing is traders looking at this and saying, okay, it's time to get in front of this, right? If you look at Middle Eastern crude oil, barrels coming off the Gulf Coast in the US, they've just now flipped into a structure called contango, right? Oil is cheaper today for delivery than it is in the future, basically implying we're seeing a near-term oversupply, and they're trying to get in front of it. So that's just going to keep pushing prices down. And as you hit sympathetic levels like this 55 on WTI or the 59 on Brent, once you see that selling, hedge funds start to pick up momentum, right? It's a momentum trade that's just going to keep going. That to me, kind of the primary drivers right now is going to push that price down. And looking like Goldman Sachs, JP Morgan have it dropping to the 50s next year, if OPEC doesn't slow down. If some of these other factors don't abate, that could be 40s or even 30s a barrel, which is going to be catastrophic for the U.S. industry.
Wow. All right. So we have a supply issue. You mentioned geopolitics too.
Yeah.
Russia, Ukraine. What about Venezuela? How does that play into this story?
Yeah, Venezuela is actually sitting on the world's biggest oil reserves, right? It's not a huge producer, but that supply matters. Ever since the U.S. seized this crude tanker off the coast of Venezuela, sanctions are there. You've seen immediate pressure from refiners overseas saying, yeah, I don't know if I want to play there. We've actually seen crude tankers heading to Venezuela, turning around in the middle of the ocean, saying this is a little too risky for me. I don't want to risk losing cargo, losing boat, losing crew. And so you're going to see that risk come down. That could actually give a little bit of support to prices because it's taking those Venezuelan barrels off the market, right? The same thing in Russia and Ukraine. If peace talks fall apart, sanctions stay on, that could boost prices back up. But right now, Venezuela is kind of this, what's Trump going to do next? Because if it gets more extreme, you're going to see tighter markets. If it gets looser, if things calm down, it's going to loosen the market.
So we've been talking about the commodity. Final question, Jay. For viewers who are listening right now, what does this all potentially mean for energy stocks?
Yeah, typically you'll see the energy majors, Exxon, Chevron, ConocoPhillips, right, trading in sympathy with crude oil prices. When crude goes up, those companies go up, and it's because production makes up such a big part of their business. Over the last month, you've actually seen a bit of decoupling. Energy stocks are going up, crude is dropping. Some of that is Exxon and Chevron just came out with new forward guidance saying, despite what we're seeing in the crude market, we are still positioned to make money. We're going to boost our free cash flow, which is going to be really good for those companies. And so the market's kind of saying, these are vertically integrated. They do upstream, midstream, downstream. They've got petrochemical divisions. They've got all these other things that aren't just production. And so the market's looking at that and saying, okay, maybe crude's going to go down for a while, probably through 26. But the energy stocks are projecting confidence. And so people are trading on that confidence. Whether that picture holds is really going to play out when you see Q1 earnings, Q2 earnings, right? How much of a hit are they taking from these prices dropping? And then you might see them start to fall too.
Jake, big story with a lot of threads. Thank you, sir. That was great.
Thanks, Josh.
With the oil industry facing a widely expected supply glut and falling prices, Yahoo Finance's executive editor Brian Sozzi sat down with Phillips 66 CFO on opening bid, speaking on where the energy company's priorities lie heading into the new year.
So looking into next year, we just announced our capital budget, $2.4 billion, very much focused on our midstream growth, specifically within the NGL value chain, and also continue to enhance our refining operations.
Within that midstream business, walk us through the operations. What does drive growth in that?
So the growth in that business is all oriented on the NGL value chain. So these are the liquids that come out of the natural gas production that need to find a home. And we process those liquids, we transport them, and ultimately the end products out of that, ethane, propane, butane, go into petrochemical feedstocks, into export markets for fuel and heat use, and also integrate with our refining operations.
Every day that we seem to be talking about, Kevin, the growth in data centers in this country, and we're building them at a rapid clip. How is this impacting the business of energy?
The major impact of the data center growth on energy is on power, so electricity consumption and demand, which we're not directly in that business. We're also a large consumer of fuel and power, but it does translate into the natural gas business because a lot of that power demand growth will be gas generation. And so indirectly, we touch it in that respect with the handling of the natural gas and the liquids that come from that.
Outside of midstream, where else are you focused? I looked at the capital allocation plan. I didn't see a large allocation to the chemicals business. What gets the industry, I guess, out of that downturn?
Yeah, so there's a little nuance there that our chemicals exposure is within a joint venture and it's self-funded.
Gotcha.
So our direct capital budget does not have anything for chemicals, but CPChem is spending, our share of CPChem, 50%, is spending about $700 million on two major world-scale facilities, both of them joint ventures with Qatar Energy, one of them in the US Gulf Coast, one of them in Qatar. Both of them are able to benefit from low-cost feedstock.
Oil prices, like I mentioned in the intro, they've come way down. How difficult has that made it for you in making profits from this business?
So it doesn't impact us directly in that we don't produce oil. We're a large consumer of oil into our refining operations. So for us, what matters is the margin between what the oil costs and what the finished products, gasoline, diesel, jet, what they sell for. And so a low price of oil, if it's not associated with weak demand across the entire system, that can result in healthy margins for the refining and marketing business.
Are you seeing healthy margins?
We have done. December, we've had the usual seasonal drop in margins, but through the third and into the sort of middle of the fourth quarter, we've seen very healthy refining margins.
We've heard it from the Trump administration that oil prices have come way down, like I just mentioned, and at some point, consumers will see this in gas prices. They will see it in their everyday lives. Like, when is that magic moment? When do all these things come together?
I think you're seeing it now. You look at pump prices, average street prices out there, they're about as low as they've been in, I think it's about 3 or 4 years. And so certainly under $3 per barrel national average gasoline price, and that's a very affordable level relative to where this has been if you look back at different points in the last 2, 3, 4 years.
Do you think further declines are likely?
It's certainly possible. A lot of it will depend on how OPEC responds with regard to their production cuts and managing their quotas.
The industry, of course, has gone through a major transformation, just given the change in the White House versus the Biden administration versus the Trump administration. How has this year been different compared to the 4 years under the Biden administration?
The primary difference has been the relaxation of some of the regulatory environment that we have been dealing with. You saw some of this with the One Big Beautiful Bill Act that was passed earlier this year, has been generally energy friendly, although there's some challenges in that as well, especially with regard to the renewable fuels business, which we are part of that value chain as well.
As you look into next year, is there one thing you're hoping the administration pulls the trigger on that might impact your industry, good or bad?
The biggest impact for us will be around renewable fuels and the flexibility to run imported feedstocks in an area where we have invested and imported feedstocks are disadvantaged right now. That's the biggest focus area for us.
From what I could tell, look, the company has been through a campaign with Elliott. There was no clear winner from this. Make the case. Why should your business stay together?
The business should stay together because we have both very real integration benefits between the refining, the midstream, the marketing, and also the chemicals business. Those integration benefits enable us to drive both more consistent and less volatile earnings, as well as enhance our returns on capital. And ultimately in this business, it's all about enhancing return on capital, and that will differentiate the winners from the losers in this business.
If you were to subscribe to some of their thinking, what would that mean to the earnings outlook for your business?
Well, some of their thinking is consistent with our own, which is around continuing to enhance operating performance, scrutinize, be ruthless around cost structure, efficiency. And so we're very aligned in that regard, and we will continue to execute on our plans around that. The portfolio breakup, we just don't feel is value creating from a shareholder standpoint when we look at what those scenarios would look like, whether it's either selling off large sections of the business or doing some other form of spin-off type of transaction.
Is it disruptive to have an activist like this as a top shareholder out there very publicly? I mean, can you do what you want to do from a management perspective? Ultimately, yes.
I mean, clearly it's they take a lot of our attention and focus. But at the same time, we listen to all of our large shareholders. Their ultimate objective is actually consistent with ours, which is to drive value creation for shareholders. And so in that context, it's a reality we have to deal with. We're very committed to driving the improvements that we've laid out, and we think that with the plans we're executing, they will be happy shareholders as well.
Coming up, a look at Berkshire Hathaway beyond Warren Buffett. We'll hear from one investor and get his take on what to expect from the leadership of Greg Abel. The downturn in Bitcoin this year is bringing down with it digital asset treasury companies. And Yahoo Finance's Inez Ferre joins us now with the details. Inez.
Yeah, Josh, and there are more than 180 digital asset treasury companies. These are companies that hold crypto on their balance sheets. Many of these are copycats of the strategy playbook, Michael Saylor's strategy, which has really been the pioneer when it comes to this kind of company as they started adding Bitcoin to their balance sheet back in 2020. But these stocks have gotten hit as Bitcoin and Ethereum and other tokens have come under pressure over the last couple of months. And there's a metric that Wall Street looks at, or that investors look at, called MNAV. This is the multiple of net asset value. This is basically the market cap versus the value of the assets. And when the MNAV goes below 1, that means that investors are valuing the treasury company less than the crypto that's on their balance sheet. So in November, when you saw Strategy's MNAV nearing 1, you saw quite a bit of pressure on the stock. Now, Strategy has sort of pushed back against this type of valuation, basically saying, look, we're an operating company. We have Bitcoin-backed securities. You shouldn't be valuing us on this MNAV. And this is sort of what most of these digital asset treasury companies are saying, basically. I did speak to one fund that has looked at more than 100 of these types of companies over the last year, and they said that they have invested in about 12 of them. And they basically were comparing what has been happening in the DAT space with the .com bubble era, when companies would sort of slap a .com on their name, and therefore they were a .com company and they were going to be profitable, etc. But the pushback is that are you an operating company also? Are you driving cash flow? And that is really going to be the differentiator here between the winners and the losers, because as one strategist put it, the industry is entering this Darwinian sort of phase where the companies with the strongest balance sheets, or the ones that outlast this crypto winter, will be the ones that sort of surge from everything that's happening with the industry right now, as we've seen these crypto prices depressed, Josh.
All right, Inez, thank you. Appreciate it. Well, Berkshire Hathaway is heading into one of the most consequential transitions in its history. On January 1st, Greg Abel officially does step into the CEO role, marking the beginning of Berkshire's post-Warren Buffett era. The big questions now are what actually changes, what stays the same, and how should investors be thinking about Berkshire in 2026 and beyond. Joining me now is Jonathan Boyar, president at Boyar Research. Jonathan, it is great to see you. So let's start here, Jonathan. You said Greg Abel, you argue, will be much more hands-on than Buffett. What do you mean by that, Jonathan? And what would that shift actually look like inside Berkshire if it happens?
Thank you for having me. Warren Buffett is known to be a hands-off manager. He has a decentralized structure. Many businesses sold themselves to him because they wanted the autonomy to do whatever they want. And that's obviously worked out extremely well for Berkshire over time. However, by having this decentralized structure and not having management oversight, there's probably a lot of fat to cut. Mm-hmm. There's probably divisions that could be consolidated. There's many things that they could do to enhance profitability that Buffett just hasn't wanted to do. Buffett is the greatest capital allocator and the greatest investor of all time. He's not known as the best manager of all time. Greg Abel might be able to do things that he wouldn't or couldn't do.
What could Greg Abel do with that giant cash hoard? What would you like to see him do with it as a shareholder?
As a shareholder, I mean, the amount of cash they have is excessive. Since Buffett is going to be gone, he's the greatest stock picker of all time, I'd like them to de-emphasize the actual stock picking. I'd like them to start paying a dividend. Hopefully over time they do that. That might not happen right away, but it would be a nice thing. I would like them also to buy back shares. It'd be great if they could make acquisitions, if they could find them. Unfortunately, a company that size, it's hard to find an acquisition that's cheap that also moves the needle.
What do you think, Jonathan, Greg Abel can do to try and, as quickly as possible, sort of earn the street's trust? Like if he came to you, Jonathan, and he was asking you for guidance on that topic, what would you tell him?
Well, I would love for him to give me a call. But one thing I would like him to do is, he owns a fair amount of Berkshire stock, but all of that was bought when obviously Buffett ran it. To me, a great sign for Wall Street would be for him to buy an extremely large amount of Berkshire stock personally and really put his money where his mouth is.
As a shareholder, how much leash you want to give Greg Abel to prove his merit here? I mean, do you give him what's the time frame, Jonathan, for you? Is it 1 year, 3? Is it 5?
Listen, we're long-term patient investors. Buffett has created a business that can basically run itself. You want him to be a great steward of these assets. You want him to go in and manage them better. And I think after a 3 or 5 year period, you would be able to see, is he doing a good job or not? And I don't think you can judge anyone on a 1 year period.
You say here the days of extraordinary returns are behind Berkshire. So what, as a shareholder, what would be a more realistic return profile, do you think?
I mean, I think over a 3, 5, 10 year period, I think it should be able to beat the S&P 500. I think, certainly the returns have been massive historically. I mean, it'd be impossible, the law of large numbers comes into play. But I think it could be a very good long-term core holding for people. That's a good diversification away from the tech-heavy, S&P 500 and NASDAQ.
What have you been doing with your own position here, Jonathan? You've been holding steady, trimming, buying?
We've basically been holding steady. If for whatever reason shares dip because people are worried that Buffett is leaving, I would view that as an opportunity to buy more.
What are the negatives, if you can try and quantify them or qualify them, of Buffett leaving? He is the oracle. What do you think can't be replaced?
Him. I mean, he is the secret sauce. People love to do deals with Warren Buffett. He got the great deals during the financial crisis. But over the last couple of years, with the exception of Allegheny, most of the deals, they haven't done much, and the deals that they've done have not been good, which is partially a result of their size. And also that PE is much more involved than ever before. So I think he will obviously be missed. I wish he could stay CEO for another 10 or 15 years, but he certainly earned his retirement.
In your opinion, Jonathan, I'll get you out of here on this, greatest value investor of all time?
Absolutely, hands down.
How so? Why so? Explain that for us.
Because he's done this for a period starting in, I believe, the 50s and 60s up until today. I mean, the longevity that he has, the discipline that he has. He did it as a hedge fund manager. He's done it by investing in companies, buying back his own shares. He's just a fantastic capital allocator.
Greg Abel, big, historic shoes to fill. Jonathan, thanks so much for your time today. Appreciate it.
Thanks for having me.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.